So thank you everybody for tuning in. My name is Hung Lu from Cash Property Inc. And we will be doing today's special conversation Q&A with Chris Boyle, specifically around EHPs. So if you don't know what that is, you got to stay tuned.
It's Executive Health Savings Plan. So the acronym is actually EHSP, which is fine. We can shorten it to Executive Health Plan. But the savings component does create, I guess, an opportunity for that forced savings opportunity for business owners on how they can utilize this strategy.
Okay. Thank you for clarifying that. And it's funny because one of the things that real estate investors, we always shy from, like the bad word for us is savings, right? Yeah. Usually in the normal world, the word debt is bad, but for us, the word savings is bad. So it actually may be a good thing if we just eliminate that S out of there.
That's fine. Executive Health Plan works too. So
now, one of the things I read on your on-site bio was that when you were going through university, you were really surprised at how little most Canadians understood about how money works. And one of the things that you also said in there was that how Canadians were inadequately informed about insurance options and investment options. And so that's one of the reasons why I wanted to have you on to talk about this option and just to give more clarification to it, specifically to how it can help real estate investors.
Sure. So I guess to give you a bit of background on that. So I took my finance through a program at NAIT here in Edmonton, and was a very good program overall. But what it definitely showed was how our country, how everyone is inundated with marketing and buying and not really investing in savings. And so a lot of people, they have no problem spending money, but a lot of people don't really understand, even the difference between simple interest and compound interest, and how those can be greatly affected on your ability to grow wealth, or, create debt. So, stemming from that information, growing out my firm, we want to take a very conscious aspect on education. And so that's, everything across from insurance, investments, savings, asset management, on what that looks like from a very broad range in the beginning, and then obviously focusing down in more specifics for each individual client. So, I guess to answer your question about the health savings plan or executive health plan, really the idea behind it is taking corporate dollars that are taxed in the low aspects. So in BC and Alberta, it's right around that 10-11% range, and getting a critical illness policy that covers the principal or key persons of that organization. And so the idea is obviously if something were to happen, a lot of people will do whatever they need to stay healthy. So if there's a cost to it, they will liquidate assets, they will reach into their long-term savings, and usually at a discounted price because they're being forced to do it to get liquidity. So with this strategy, it allows you to transfer that risk onto somebody else, in this case, the insurance company, and they would pay a tax-free lump sum where the business owner can do whatever they want with that money, whether it's get treatment. If they're doing their own property management, they can hire somebody else to do property management for them, and they're not having to drain or liquidate other assets in their portfolio. So that's the main reason to, I guess, mitigate the risk, or why somebody who's a real estate investor would look at doing this. The flip side of this, and where the extra bonus comes in, is we can structure this where if the business owner does not get sick, anytime after the 15th year, all those premiums that the corporation paid would come back to the individual at this point with no tax and no penalty, and they'd receive that money personally. So it's a tax efficient structure that can be built as well on helping them get money out of their corporation tax efficiently with having protection along the way.
Okay. So this would only work for somebody, one who has a corporation.
No,
So if they're buying properties under their personal name and that's all they've got, then this doesn't work.
yep, it does. It still works that way. It's just not as tax beneficial.
Right, because
Right,
they
'cause
wouldn't
they-
get that. Okay, so
There's-
explain why it wouldn't be tax beneficial then.
Right. So in Canada, business owners have what's called the passive income tax rules. So they're different than your active. So if we're looking at that, an active income in a corporation would be the day-to-day duties of what you're doing, right? So if you're a dentist, let's say, and you provide dental services, that revenue you bring in is going to be taxed at a smaller tax rate than what if you were investing through your corporation would be. So in Canada, and this is an average across the country, your active tax rate for investable assets inside a corporation is over 50%. Okay, it's right around, and it depends on province. With utilizing a strategy like the health plan, that money that gets put into this policy, it's sheltered. It's not exposed to any of that taxable income that you would have on the passive side. And then the other aspect is when the money comes out of the corporation to the individual, it bypasses the dividend tax or the salary tax that they would pay themselves. Okay. If an individual wants to do it, they can, but it doesn't go through a corporation, obviously. So they would pay for it with their higher personal tax dollars, after tax dollars. They still get the benefit back being personally tax-free.
Okay, gotcha. Okay, so ideally you want to do this under a corporation, which a lot of investors will have a corporation set up anyways. Is there a threshold where it says, okay, if your real estate corporation is making less than 100,000 or 200,000, like is there a threshold where it says this may not be a good option for you?
There's no threshold for minimum. We have a threshold for maximum. So in Canada, no individual can have more than $2.5 million of critical illness insurance coverage on them. Okay, that's just set by the insurance carriers. From a structure standpoint or what it looks like for each individual, it can be customized to match what they're looking to do, whether that's from a cost standpoint or a coverage standpoint outside of anything over $2.5 million.
Okay, so right, so that's the coverage side, but from an individual investor who has a corporation, at what point in their books where the income from their corporation would make sense for them to get a policy, or that's not even a consideration?
Yeah, it would really be from day one, because do they have a risk if something happened to them and they've got a critical illness? Right, like most people, when they're building up assets and something were to happen to them, there's a risk there.
Right. No. So I'm asking, like, so if the corporation is reporting a 50K profit, but their premiums going out are 50K, right? Like, is there a threshold where it makes sense for the investor to say, hey, you know what, I'm writing off, I'm writing 200K of income here, so then now it makes sense to do it, or like it only makes sense if somebody's at the 500K level?
Yeah, there's no minimum threshold. Like, we can build a plan technically for somebody for $100 a month.
Okay.
Right, so it is really customizable to match what the business owner is looking at doing.
Okay.
And there might be different goals per individual too. Some people just might want cheap coverage in case something happens, where it wouldn't have the return of premium, but it's more cost efficient.
Okay, so you answered my question there. So really, like, a policy could be purchased for like, $100, $200 a month. So the cost effectiveness of it, really, the amount that it costs to buy one is not astronomical, right? Compared to some of the other policies that we've that we know about.
Yeah.
So just to clarify, critical illness, just so that we're all on the same page here, if you can give me like a really short, quick understanding of what's included under the definition of critical illness.
Sure. So even to give you back history on the idea where critical illness came from, was actually from an African heart surgeon. And what he found out is after individuals were coming to get a surgery, he would follow up with them. And there were times where the individuals weren't doing very well. And so he wanted to know, was it something that the organ wasn't taking? Was it another aspect? And what he found out a lot of times it was, is the financial stress of these people, once they've came back into their lives, was deteriorating their health or was overwhelming them with their health. And so he thought, well, why don't we change that financial risk and put it on somebody else, which is the insurance companies. Okay.
Okay.
So critical illness, some people get it confused with disability. Critical illness is a one-time lump sum that an individual would get if they match or meet the criteria of what is being critically ill, which is the question you asked. So it is different per insurance company. Usually insurance carriers will cover anywhere from 4 to 24 different critical illnesses. And they would include things like stroke, heart attack, major organ replacement, organ failure, severe burns, life-threatening cancers. And so life-threatening cancers, once again, it's really understanding the definition of each carrier's, how they look at cancer. Usually if it's metastasized, okay, that's considered life-threatening. But a lot of carriers have early detection. So if it's something like prostate cancer, there'll still be a benefit. Policy will still stay in place, but the whole policy wouldn't pay out.
Gotcha. Okay. So that actually would explain why some people have critical illness, disability insurance, and all this other policies, because it's not being overinsured then.
No, and it's different. Like, so example, paralysis is part of the coverage on critical illness. Well, if somebody were to come paralyzed, they probably got to retrofit their entire house. And there's a cost to that, right? Disability would provide the ongoing income supplement, but disability is not going to help you if you've got a 30,000, 40,000 retrofitting of the house that you have to do, including ramps and all that. Wow. Right. So it's a one-time lump sum. Another big thing that we're seeing for some reason in Alberta, we've got huge multiple sclerosis rates, MS. And they're doing fantastic things out of Costa Rica and Europe right now on stem cell research and transplanting, but it's not cheap, right? And once again, if people get ill, they're going to do whatever they can to survive. And so if somebody else is going to pay that medical bill, it's worthwhile looking at. And a lot of people don't think they'll ever get sick. And if they don't, well, all the money comes back to them anyway.
Okay. So this EHSP, where's the savings portion?
Yeah, so every month or annually, the individual can choose how they want to pay. So that money essentially goes into the policy. Okay, so it's a forced savings. And the reason we use the word savings in that front is they're getting it back. If they get sick, there's a payout, right? If they pass away, we set it up so all the money comes back to the corporation. So they're not out those funds if they do happen to pass away. And then the third, if they stay healthy, it's all coming back to them as well. So one way or another, that money is there for them, whether it's short-term or long-term.
Okay. So if they pass away from natural causes, does that money still come back?
Correct. Yep.
Okay.
Even if it's unnatural causes, no matter how they were to pass away, that money would come back to the corporation.
Okay. So if I put in $100 a month for the next 15 years, okay, at the end of that 15 years, that money would come back to me anyways. Or if I died within that 15 years, that money would go back into the corporation.
Correct.
Okay. Or if I got sick, then the policy would kick in.
Correct.
Okay. So if a real estate investor has multiple corporations, how does that work?
Yeah, the interesting thing with critical illness is there's no deemed disposition, which means you can move that policy around to different corporations whenever you want. There's no tax liability with it. But from a planning standpoint, anytime we hold insurance, we look to hold it in their holding companies.
Okay.
Okay, so if it's multiple and they've got multiple, webs of corporations, they usually have one holding corp,
Yeah.
where a lot of stuff flows up to. That's where
Yes.
we would hold the insurance policy.
Gotcha. Okay. So then it doesn't matter how many corporations you have. It really is the holding company that takes it.
Yes.
Okay.
Yeah. Corporately held life insurance is different. It always should be held in the holding corp because of the disposition on tax if it's moved.
Okay.
But
Okay.
CI doesn't have that. So there is a bit more flexibility, but we still always look at holding it in the holding company.
Okay. So can you share a couple of examples of some of your clients that have taken this and what they did with
Mhm.
the policy or the money, or like?
Yeah. Yeah. So the individual's industry, I guess, he's a dentist. So with his practice, they have extra revenue, obviously, that they don't utilize, but there's also a major risk if something were to come and he were to get illness, he couldn't, work in his industry, right? So what they decided to do was take out a policy that was owned by the corporation, and they pay for it for a span of 15 years. After that time frame, he can assess if he still wants coverage, he can have it and still carry forward with it, but he can also choose to cancel that policy, and all the money that would have been paid into it is going to come back to him personally. Okay. Now, if there is anyone watching this that is very aware of some tax rules, the one stipulation that we have to be conscious of is CRA says that we can't take assets out of a corporation without paying a benefit to do so. Okay, it's kind of written right in tax code. And so how we deal with that is this policy is broken down into 3 different sections. The policy premium, there's a return of premium on death rider. So that's what we had talked about earlier. If there is a passing, all the money comes back to the corporation. And then there's also a return of premium on surrender. So that portion of the overall premium is an individual tax benefit to the business owner each year. Okay, so that's a reporting thing that we work with their accountants on. And what that does is it allows us at the back end to get all that money back out of the corporation, and it goes directly to the individual, bypassing the dividend or salary tax.
Are those broken down in equal percentages, or like okay?
No. Yeah, each insurance company has set their own structure on that.
Okay.
And then beyond that, depending on how we set up the policy itself, will determine the breakdown of those premiums. So
Okay, gotcha.
we can do an internal ROI, essentially, is what it comes out to be on what the value of that, premium that you pay on that would be.
Okay, gotcha. Okay, so just a clarification question. So let's just say I have a policy, 15 years goes by, everything's fine. I haven't gotten any critical illness, and I continue, and I want the policy to continue. So it's not that I stop paying after 15 years, is that I would still have to keep paying.
It depends. We can set it up both ways. So you can set it up so it's a 15-year pay.
Okay.
So after that time, you still have your policy in force, but you're not making any premiums.
Okay.
Or you can choose to continue to pay beyond 15 years. And each year you keep paying into it. Anytime after that you cancel the policy, you would still get everything back.
Okay. So what you're getting back is that dollar for dollar that you put in.
Correct.
Okay. So there's no interest being made on that money.
There's no interest being made, but if you look at it from especially a corporate aspect, if you were to deploy that money any other way, whether you're taking the money out of the corporation and paying your dividend tax, or you're reinvesting it into any other means, you're going to be paying that high 50% interest, that tax on it, right? Mm-hmm. So there are ways that we can calculate, once again, an internal rate of return on it. But there is no interest on that money while it's with the insurance company.
Gotcha. Okay. And while that money's in there, we're not able to access it, like
correct.
In an IFA strategy, which is
correct. So the biggest risk would be the illiquidity of the policy for that 15 years.
Okay.
Now, there is some flexibility if somebody wants access to that money before the 15 years. We have certain carriers that do that, but if you last the full 15 years, they're not going to give you back 100%. So it's, looking at what's really important to each individual client. But there are some options there. But for the most part, I tell clients, this is a, long-term plan. There's illiquidity to it. And we want to make sure you have other liquid assets if you need to access before implementing a strategy like this.
Gotcha. Okay. So in terms of the amount that I would put in, or an investor would need to put in for a policy like this in exchange for the payout amount, is there a ratio there?
It all depends on age, health status. Those would be the big factors,
Okay.
right? So somebody who's younger and is healthy obviously is going to have cheaper premiums than if somebody's in their 60s and might have, a smoker.
Okay, gotcha.
Yeah.
Okay, so for example, let's say somebody's in their 40s, fairly healthy. What type of premiums and coverage would they get?
Yeah, once again,
No?
there's no direct answer. Like, if they want, let's say $1 million of coverage for a 40-year-old that's healthy, are we structuring it where they're going to pay to 75 with the option of getting it done at 15 years, or do they want to pay it up in 15 years, which means that their premiums are going to be more expensive for those 15 years, but they're done paying at that point. So the best way to answer your question is we can fully customize this to each individual based on what their cash flow, their expenditures would want to be, and how much coverage they would want to have.
Oh, I see. So if the time frame to pay is 15 years, then there's a different amount than if the person was to continue to pay after the 15 years.
Correct. Yeah. Time value of
Gotcha.
money,
Okay.
right? Says overall, the paid for 15 years is going to be cheaper, even though it's more expensive for those 15 years. But overall, in the plan, it's going to be more cost effective than if somebody paid to age 75.
Gotcha.
Right.
Okay. Gotcha. So it really is a long-term strategy here. Like, it's not a short-term strategy.
Yeah. So let's say we come across an individual that they're healthy now, but they know that there's health concerns in their family as they get older.
Okay.
Right. So they might look at a term to 75 option where they have the ability and choice to go all the way to age 75 for coverage. If they don't want to pay all that within 15 years because cash flow is more of a restraint, then we'll stretch that out. But still, anytime after that 15th year, they can get it all back.
Gotcha.
So it just gives them more flexibility. And then there's also a term to 65 option if somebody wants to take it all the way to 65, but they have to pay until age 65. There's no 15-year time frame. So depends on the client, depends on the cash flow, depends on the coverage that they want.
Mm-hmm.
It really is customizable depending on what they're looking at doing.
Okay. Gotcha. So do you have an example of like a real estate investor who went through this process and then decided to get the policy that you could share?
I think there is one for sure. So they're, I think, 4 years into the policy right now.
Okay.
They are in a situation where they only have one corporation. So essentially it acts like a holdco. So they don't have multiple webs, if you want to call it that. And what they're doing is the rental cash flow that's coming in, they're in a positive situation, and they're taking a portion of that, not all of it, and putting it into a policy for themselves, where the idea behind it is they are their own property managers on their units. So if something happened to them, they're not going to be able to do that. They're not going to be able to collect the fees that property management is bringing in. And so they're using this policy to subsidize that risk, protect that income that they have coming in. If something does happen, they can hire another manager to come in and manage those properties. And then 3, if they do, they never need it, they stay healthy, all that money's coming back to them personally.
Okay. Now, you had mentioned to me something about the paying half of it under the corp and paying half of it under your personal.
That was more of that split I was talking about earlier on how much is the return of premium rider and how much is the other components of the premium.
Okay, but the whole amount of the paying for the premium, 100% of that can come from the corp.
Correct. The insurance companies prefer that because then they don't have to keep track of the split. Where some insurance companies, they'll only take premium as a one source, not multiple sources, and then trying to figure out who is what.
Okay, right. So then paying for the premium can come from the corp 100%, but then
Correct.
down the road when you're getting the money back, then that can be that goes to the person, not the corporation.
Correct. So
Right.
that's where we talked about that personal tax
Yeah.
benefit that has to get reported each year.
The personal tax benefit has to get reported each year.
Correct. So if we know, I'm just going to use straight numbers here. If it was $500 a month premium overall,
Yeah.
and 300 was the insurance cost.
Okay.
100 would be the return of premium on death. And then $100 would be $100 would be return of premium on surrender.
Yeah.
That $100 monthly or $1,200 annually would get included into the business owner's personal income.
At the current time, not in the future time.
Correct.
So then that would count as income now.
Correct. But
And I would be paying taxes on that now.
correct. So if we look at it, it's usually a very small amount. So if you take 1,200 and include that to somebody's income for the year, usually they're, let's call it a dividend. So right around the 30%, they're only bringing in 1,200. So they're going to be paying $300 tax on that money.
Okay.
Now, if you take the $500 a month and multiply that by 12 months, so 6K, and multiply that by 15 years, I don't calculate in front of me. But now that whole amount would come to that individual tax-free at that time, where they paid a very small taxable benefit to get it out.
I see. Okay. One of the things that real estate investors do very often is that they just buy a property and use that as their insurance policy rather than buying a physical insurance policy. So what would you use to sort of counteract that strategy?
Yeah. For one, if something was to happen to them and they needed access to capital and their real estate is their largest asset and they've got to liquidate it, what if the markets are down and they're not getting full value for it? Right. So sometimes it comes into liquidity. When you need money, is money going to be available for you? And if it isn't, you have to liquidate assets at a stressed situation, which you're not going to get full value for.
Mm-hmm.
Okay. Plus, and then you include your realtor fees and all that other stuff, right? So that would be one conversation. Two, it's diversifying somebody's overall portfolio, not only from an asset standpoint, but also a tax standpoint, right? Are your corporate assets set up as tax efficient as possible, right? Other than that, real estate, as we know, is a fantastic asset. It is great. But who's managing that asset, right? And if you're not around, you're worrying about your health, who's collecting rent, who's looking after, who's doing the servicing on the properties, depending on what you're doing. So it really depends on each individual and how they view their own health and their own asset, because if somebody's buying real estate, they probably think that that's the most precious and valuable asset they have in their portfolio, when it's actually themselves, right? And so making sure that you're protecting that asset, you're securing that asset. And people buy real estate because they want to mitigate risk, right? They see it being a less risky asset. Well, anytime that you can transfer risk onto somebody else and still get everything back, or it paying out no matter what happens, is something I believe everyone should consider, because real estate usually has a connotation where I'm paying into something, but I may never use it. And the money I'm putting into it is just going to be gone. All right. That's how some people feel about, auto insurance. They're just the insurance in general, right? Where this is truly a living benefit. It pays out if you get sick. It pays out, it has a death benefit, pays out if you die. but ultimately it's got that nice benefit coming back to the individual if they stay healthy.
Right. Gotcha. Okay. All right. Yeah, it's funny because I think a lot of people view real estate not as a way to mitigate risk, but a way to just get financial freedom. But they don't realize, that it's to mitigate risk, right? So
yeah, and it's, risk is such once again a general term too, right?
Yeah.
Real estate usually limits the volatility risk of somebody's portfolio, but it also can increase their liquidity risk, right? So
yeah,
it is about that balance. But yeah, it's just another option that is available to them to mitigate their overall risk of their portfolio and their assets.
yeah, and especially with the economy the way it is now, like a lot of us are seeing a softening in the economy where we are, right? And so if we had to sell something right now, or if we had to get access to cash right now, would we be able to do it as easily?
Yeah.
Right.
Yeah. And
so you bring a good point up.
Some people will think, well, just take a second mortgage out or a line of credit to access some capital out of my equity.
Yeah,
well,
for sure.
Do you think a bank's going to give you that if they know that you're going through a critical illness and, if you're still working a full-time job, that you're not going to be getting, full income, right? I tell my clients, you should always set yourself up to get stuff, especially on a lending capacity or asset base when you don't need it, as opposed to when you do, because the banks don't like giving it to people that need it. Right. So.
Okay. So now one of the things that I know somebody's out there is going to be thinking is, can they use their HELOC money to get this premium for their corporation?
They could, but it wouldn't make sense.
Okay.
And there's a couple reasons why.
Okay.
So one, there's no benefit because you're not quote unquote borrowing money to invest. So you wouldn't be able to write off the interest component of that.
Okay.
Where if it was borrowing money for real estate, then yes, you can write off the interest on that component, right? Two, I guess the only way it would make sense is if they really wanted that protection and the numbers worked.
Okay.
But once again, they're not able to write off that interest, so that reduces the viability of doing that.
Okay, so this really does make sense when if you have the holding company or the corporation, and then you've got excess cash.
Correct.
In there.
That's right.
Right. So, yeah, and especially if you've got rental properties and you're seeing a positive cash flow, then that's where you would be pulling that out to pay for the premiums.
Correct. Yeah, and you're not pulling it out. Right. So
right, you're not right.
That's
you're redirecting it.
Correct. Yeah. The corporation would be paying for it. So yes.
Okay. So in some of the deals that I'm doing now, I'm going in as a silent partner, and there's a managing group that's managing the property and the investment. Does it make sense for the management team there? Because one of the things that you told me before was that whoever gets this policy needs to be the signing authority, right, of the corp?
Yes and no. So to give an example, we've got situations where we use this on key employees to make sure they stay around for 15 years. So in your situation, if you're a silent partner, but you've got a management group that you're a partner with that's managing the properties, you could essentially take out a policy on them where if something happens to them, now there's money back in your corporation to hire a new property management, and you want them to stick around. So in 15 years, if they stick around, they would get a portion of that benefit. So there's different strategies that we can use to not so much like you can do it in the residential world, but even in the business world, if you've got key employees that you want to stay around, it's called the golden handcuff, right? They stick around, and if they do, after the 15 years, they get some of that benefit back. And in the meantime, you've protected your business. You've kept that employee or quote unquote property manager around for that long. And if they're key to your business and something happened to them, would your business and real estate portfolio be adversely affected?
Right. So then with the so some of the money would go to them on surrender, but then the payout, if they got critically ill, the payment would go to them or go to the corporation?
Yeah, we can split it up however you want that agreement to look like. So a lot of these times when we do these policies, we have an agreement that is with it that outlines who's the beneficiary if this happens, who's the beneficiary if this happens, and then what that split would be.
Gotcha. Okay.
Yep.
Yeah, because nowadays we don't see people staying at many companies for more than 3 years,
No.
right? So,
No.
but if you are a key player, then most likely, you know, you're at that higher executive level, right? Yep. So, okay, gotcha. Oh my God. Okay, so we've been talking about this for like 35 minutes.
Well, you got great questions.
So is there anything else that you can think of that somebody should know about the EHSP?
Yeah, the biggest thing is the risk, right? And a lot of advisors don't really go through the risks on strategies like this. But for this one, it is that illiquidity component to it, not having access to the cash that's going in. So it is a long-term strategy.
Right.
The other aspect, and you know, it's not a concern for me because I'm, you know, in constant conversations with CPAs that are well connected with the CRA, you know, tax specialists on the ongoing tax treatment of this. So what we've got from the insurance companies and the CRA is they have stated that return of premium is not taxable. Yep. Okay, so that money coming back is not taxable. The deemed disposition, there is no way a government agency can ever say that somebody's guaranteed to get sick. And because of that, we know that if we have to transfer this, let's say from a corporation to an individual at some point, because the corporation, it just doesn't make sense for it to hold it there, or they've sold off assets, but they want to keep all the money they've put into this thing, that there's no taxable event doing that transfer. Mm-hmm. Okay, so that we know. And then two, we do know to stay on side with CRA, the CRA says that we have to pay that taxable benefit or, you know, pay for something to get assets out of the corporation long-term. And so that's why we set up the structure where there is a small portion that is a taxable benefit to the individual.
I had one follow-up question here, because the thing is, for the last, I would say 3 to 4 years, I've reached out to different insurance providers. And I'd be like, okay, tell me what I can get insurance coverage wise so that it benefits my real estate portfolio. And, you know, even as far back as like as recent as 6 months ago, I reached out to somebody. I said, hey, I heard this crazy thing that I can get critical illness under my real estate corporation and have my real estate corporation cover it. And they flat out said, no, there's no such thing. Right. Yeah. So my question to you is, how come this is not like this knowledge, this education, this policy, this program is not out there and readily available to individuals? And how come other insurance providers just don't know about it?
Yeah. Well, first I'll talk about the banks. So a lot of people deal with the banks. Some banks are licensed to sell insurance products, but not every insurance carrier has access to products that fit the strategy. So there's only a couple companies in the market that offer that return of premium option. Okay. So that could be one reason, depending on who you talk to and what company they were affiliated with or what contracts they had with certain insurance companies, they might have been correct that it's not available, but it's just not available to them because they don't have access to it. Okay, so that's one aspect. Two, I would say less than 10% of licensed advisors across the country understand the corporate structure, understand the corporate tax structure, and how to integrate product or solution into that situation. You know, I'll give you an example. I met with an accountant a couple of years ago, and she had a policy like this. And I reviewed it for her, and it was set up incorrectly. So she's an accountant. She doesn't know the insurance world. The advisor that helped her basically was just selling her a product and wasn't incorporating the proper strategies around her corporation on how it could match.
Okay.
So another aspect to answer your question is there's limited advisors that know how to do this.
Okay.
Okay.
Okay. So when somebody's going out to try to find this policy, what's the name that they should be using?
So there's two real names. It's either a split dollar CI, so split dollar critical illness, or the executive health savings plan.
Okay. And why is it called the split dollar?
So we're splitting the cost of the premium, right? So we talked about that individual taxable benefit.
Okay.
So that's being split, the cost of that with the business.
But the business is paying 100% for it though.
Correct. That's just the structure we have to have. But at the end of the day, the individual is paying a small portion, but they're just taking it as a personal tax benefit instead of being paid out that extra amount on their salary or dividend, right? It's just included in their income.
Okay, gotcha. Right. Okay. So the split dollar or the EHSP.
Correct.
Okay. All right. Is there anything else that we need to know about this?
No, just I guess making sure that you're asking questions. You know, any individual that's looking at this is asking questions to make sure, does it fit? And that it's not the only strategy, right? If you've got, $15,000 a year that you've got as retained earnings and you're looking at doing the strategy, it probably does not make sense to do all 15,000, right? Making sure that you're well-rounded, have access to other capital. And this is just an addition to risk mitigation on everything else that you're doing.
Gotcha. Okay. And that's something that somebody could sit down with you to get that sorted out.
Yeah. Yeah.
Okay. Yeah. And especially if they need to do that internal ROI calculation. Okay.
Yeah. Yeah. That's going to be different on every policy depending on how it's structured.
Okay. Okay. Gotcha. Okay. Thanks so much, Chris. I really appreciate you taking the time to share this because this information is not readily available out there.
Well, thank you. I appreciate you taking the time to talk with me.
Yeah. Well, if there's any way that I can, safeguard the wealth and the portfolio that I put together for my family, this is part of that education that I need to give myself. Right. And so it's really, when I read your bio and realized that, that you really do want to educate individuals so that they can make the right decisions for them. Right. That's in alignment with what I'm doing right now.
Yeah.
Right. So that really did resonate with me. So that was good. So I will give you the floor to close out with any sort of last minute comments, stuff like that. If there's anything that you want to do.
Sure.
Okay.
Yeah. Just once again, thank you again for having me out. And, there's a lot of information that you're right is not readily available to business owners when it comes to protection or strategy. And one thing I just would tell them all is to make sure whoever you're working with as a financial advisor, accountant, and lawyer, that they're all communicating with each other and building a full advisory team, because it's very rare. And a lot of times it's because the financial advisor is not comfortable talking with those individuals. So encourage it, get your advisors to reach out to your accountants and lawyers and have everyone work together, because everyone needs to be on the same page, especially if you're building a large portfolio of wealth. And you want to focus on stuff like transition that wealth to the next generation tax efficiently. All right. So, but yeah, other than that, if you have any other questions, feel free to reach out.
Yeah. Okay. All right. Thanks, everybody. Thank you for watching.